We call it natural capital, and what we basically refer to is, say, the earth, air, land, water, and biodiversity. You can think about it as the earth planetary infrastructure, if you will, and that infrastructure is providing a service.
Why biodiversity is important? Well, it's pretty simple. We depend on it for everything, whether it's the air that we breathe, our food, our water, our medicine. But we have a problem, and the problem is that in the last 50 years, we have decimated biodiversity globally.
If we don't invest in what's called our natural capital, so our forests and our soils, then we have no planet. It's a bit of a no-brainer, but getting people to kind of understand that we need to invest in our natural capital is really quite challenging at the moment.
In order to really scale, you have to also have scalable investment opportunities. Otherwise, you can't attract real mainstream investors. So we want to build a very large scalable business around natural capital. There's a business opportunity to create a natural capital investment business that attracts large institutional and corporate investors. That's what we created.
Over 83% of you that listen to or watch this show regularly haven't yet subscribed to this show. So could I ask you for a favor before we start today? If you like the show and if you like what we do here and you want to support us, the free and simple way that you can do just that is by hitting the subscribe button or following us on your podcast app. It helps this channel more than you know. Thank you and enjoy this episode. Give me a high-level introduction and overview of climate asset management, and include in that what's your mission and what's the company's main activities and key strategies and number of funds, etc.
It's very simple. Our main mission is to mainstream natural capital. So one of the observations we had in the beginning was that natural capital to this point was very much of a niche product. So there were lots of smaller impact funds, some very good, as Tammy's fund, for example, but they were relatively small. And what I learned at the European Investment Bank was that in order to really scale, you have to also have scalable investment opportunities. Otherwise, you can't attract real mainstream investors. So in a way, that's really the mission that we're having. We want to build a very large scalable business around natural capital. I think we saw, if you think about almost like a Venn diagram, we saw basically the smaller impact funds. We saw the more mainstream agriculture fund and the more mainstream forest and timber funds, or TIMO supported or TIMOs. And our analysis was that in the middle of this Venn diagram, there's a business opportunity to create a natural capital investment business that attracts large institutional and corporate investors. And that's what we created. So we started off in our first investment strategy is a real asset strategy, where we're offering to institutional investors to invest in underlying projects, mainly around agriculture and forestry. And what we're doing in a nutshell is we are, for this strategy, we are buying land in developed markets. We always have a thesis why we're buying the land and how we improve it, how we improve the impact, but also the economic return. And then we're selling it after 15 years. From a business perspective, so the way we make money is that we are creating sustainable yield. And the thesis here is that often you can create better long-term yield if you have a longer investment horizon. So for example, on the agriculture side, the traditional model has been to invest, usually to lease lands, and then to have an investment around 6, 7, maybe 8 years. And then by definition, you're required to get as much out of the land as possible, usually with not very friendly environmental practices, using a lot of pesticides. So we wanted to turn this around and saying, if we had 15 years, what can we do? We can actually implement very sustainable or more sustainable practices that also create over time, over the 15 years time, better yield, and they enhance the value of the land. In addition to that, we also look to bring in new revenue streams from natural capital. It could be CO2 for forestry projects or carbon credits, but it could be also conservation easements in the US. And we also measure all the biodiversity so that should there be a possibility to also receive a financial return for that we will then be able to also integrate this in our strategy. So that's one strategy. Maybe I pause here because I'm sure you have lots of questions.
You have two main strategies, correct? One's
That's right,
natural
yeah.
capital and the other is nature-based carbon.
That's correct. And that's the one I used to head. And that's a completely different strategy. So here we looked at what other opportunities do we see around natural capital. And one thing we saw is that corporates came to us and said, look, we have a net zero target. We know already today that we won't be able to fulfill this with own action alone. So for the delta or the last piece in the puzzle or the last part of the journey, we will have to buy some carbon offsets. And what we want to do is don't want to go now to a broker and buy them. We actually want to invest in projects, high quality projects from nature or natural capital that can generate high quality offsets for us over a longer time period. And so we created as a second strategy also a vehicle that allows corporates to put money upfront into projects. And what we're doing is we're not buying land because it's an emerging market strategy, but through a contractual arrangement, we basically are able to prepay projects and pay for high quality carbon credits on delivery over time. And that strategy, we are not delivering a financial return, but with that strategy, we are actually only delivering the carbon credits back to our investors. So we have two very different strategies. On the one hand side, a very more classical real asset product for institutionals. We have mainly insurance companies in there and some pension funds. And then we have the other one, which is a corporate product in emerging markets where we're helping them to invest in and source high quality carbon offsets. And so that also allowed us to run these strategies in parallel because they're completely independent from each other, but we can actually cross-fertilize some of the talent and some of the experience that we have in the firm.
Just to fill out the picture on climate asset management, how many funds do you have and how many employees and just a few other things just to get the high level?
We have those two strategies, 3 vehicles, and we have now over 40 employees.
3 vehicles, meaning funds that you're
Yes.
using. Are these open-ended, closed-ended funds?
They're all closed-ended. They're all 15 years, and we think that's one of the key criteria that in order to make natural capital investing workable, one needs a longer time horizon. Actually, I think it would be even easier if you could go longer. However, that's very difficult on a closed-ended basis with many investors.
So roughly double the average private equity fund.
I would say the more comparable funds on the forestry side or on the impact side is probably 10 years, I would say. So it's probably...
I don't know if you publish AUM, but do you have any kind of reference point?
We raised over 650 million at the end of 2022. We are now at the moment finalizing our fundraising. So I can't give you the final number, but we are well advanced on that and will come out in hopefully after the summer this year with our final number, but we're in a good way.
And when did you start fundraising? Was that 2020 or was it 2020? 21. Right. Okay. So before we drill down more on the specifics, give me a clear definition of nature-based capital. And so everyone's starting at the same point as where Martin Berg is, and explain to me why it should be important to investors.
Sure. Well, we call it natural capital, so for starters, and what we basically refer to as basically you say the earth, air, land, water, and biodiversity. You can think about it as the earth planetary infrastructure, if you will, and that infrastructure is providing a service. In very simple terms, the bees through their pollen help us to almost sustain life on the planet, and yet we're not providing any value to the services the bees provide to us. And that's, of course, a known fact. But I think now the question is, why is it important to investors? Because in our view, we believe that nature is now the next thing, and this is for 2 reasons. On the one hand side, we're seeing a second, let's say, environmental crisis looming, and it's becoming, I think, very visible in parts of the world, and this is the biodiversity crisis. And yet that biodiversity crisis also has a huge impact on the climate crisis. Nearly 25% from all emissions are land use, land based. And I think, and I had it actually, it was interesting. I met the other day an old colleague And she put it in a really nice way. She thought, like, I thought always climate was all about energy. And I said, yeah, me too. But actually, when you look at the statistics, it's not. It's actually also all about how the land use change, how it's called in the UNFCCC kind of jargon. And why is this, you could say, well, why is this important to investors? And many investors are saying that. But also investors said this 10, 15 years ago, why should I care about the climate? It's terrible what happens to the climate, but what do I have to do with that? And I think we think it's the next thing that investors will have to deal with. We saw it on climate. It starts off with the problem becomes clear from a policy perspective. The next step is saying, okay, how is it actually impacting supply chain of companies? Who is actually responsible for it? And then how is the finance sector imposed, and what risk does it mean for the finance sector? And then in turn, the moment we're talking about risk, somebody will say, well, that's something I learned in the hedge fund. Everywhere there's a risk, there's an opportunity. So where are the opportunities of investing? And I think it's very true. And I think that's something we've seen. If you look at the playbook, how climate became such an important topic for institutional investors, I think you can see why nature is just the next thing that could follow a very similar path. And that's why we believe that investors will not get around to deal with it. And from the interest from investors that we're seeing at the moment, I think they clearly understand that.
Describe what is a natural capital investment strategy, because you're talking about something that's distinctly investing and not just doing something, making a better world, but you're talking about something where you lay out capital and you expect a return. So what would be a good example of natural capital investment strategy, and describe where is the value in such a strategy?
And I think we have to distinguish between the economic value of nature and the financial value that you provide to investors. But I think you're probably more interested. Well, you're probably interested from where you come in both, right? But I think that's the crux at the moment, that we know that there's an economic value that nature is providing, but we're actually not transporting it into a financial value. And I think maybe that's the easiest way. In an ideal scenario, if you ask me, what is natural capital investing, is that you move from an economic value into a real financial value. And if you can build a strategy around that and you achieve an improvement of nature while also creating a return, then I think that's, for me, that's kind of the gold standard of natural capital investing.
Also, what asset classes are you focused on? Are you an equity or?
We are a real asset equity fund. We are basically in our natural capital strategy, we will apply also some leverage, but usually we come in as an equity investment, and later on we will optimize the asset with some debt, but actually quite moderately. And so it's similar to what you would see on the infrastructure side.
And also, do you have a particular regional focus?
Yeah, so for the natural capital strategy, we are in developed markets. We're investing in North America, in Europe, in Australia, and in New Zealand.
And then on the carbon, is that developed countries?
Yes, so that's the nature-based strategy. By definition, it's global, but given the price points that we're trying to achieve, we're mainly active in emerging markets.
Can you tell me about climate asset management's theory of change and the problem you're trying to solve?
We need to move capital from activities that actually destroy nature to actually helping to improve nature. And I think that's something I'm feeling really strongly about, that we only have a chance to address both the climate and the nature problem if we move larger pool of capitals into the right direction. I'm very much subscribing. I'm feeling very proud of myself if I'm able to move the course of a very large institutional investor by 1 degree or 2 degrees, rather than having a very small and perfect investment vehicle with a few, let's say, very sophisticated but investors on the impact side. So I'm a firm believer that in order to solve the big environmental problems we're having, we need to change how large-scale capital is allocated. And that's really our mission statement. That's what we want to achieve, and we're doing it only focused on natural capital. I think that applies to many other environmental problems, but that's really our, if you will, our mission statement.
You've identified two principal strategies, the natural capital strategy and nature-based carbon strategy. Am I saying those right? Is that the way you term it? Yeah. Give me one or two high-level examples of what one of these investments looks like, just so listeners can picture exactly what the hell you're talking about, to make sure we're all thinking of the same thing.
On the natural capital strategy, I think the best project I can think of to describe it is we bought 1,800 hectares of land in Queensland in Australia. And at the moment, or that's actually we're just in the process of converting it, but when we bought it, that land had only sugarcane planted on it. Sugarcane is notorious for being a monoculture and also being notorious for needing a lot of pesticides in order to provide the annual yield. And it's also known for having very aggressive runoff into the ocean, which in that part of the world has also severe consequences. For example, the bleaching of the Great Barrier Reef. So what we're doing is we bought that land. We are now converting it to macadamia with cover crop plantings in between. So where we basically moving from a we would say very unsustainable way of producing sugarcane to a sustainable way of producing macadamia. Macadamia is a really interesting investment opportunity, even if you, let's say, forget all the environmental benefits that we are producing with that. It's a super nut. In that part of the world, it's indigenous, and it has a great market in Asia for future demands. So it's also an attractive investment opportunity just on its own merits. But what we're doing with the land conversion, we are also achieving massive environmental impacts, in particular in regard to biodiversity. And what's special on this project is actually embedded between two national parks. And these national parks have some very rare plants. And what we're allowing is we're always setting aside at least 10% of our land for each of our projects. And with this set aside, we're allowing some connectivity of these national parks. And that means that these two parks can be connected. And one way to enhance biodiversity is to increase connectivity between just to increase connectivity. That's one of the best ways to enhance biodiversity. So if you look at this is a really attractive investment opportunity, but it also has a land use change kind of thesis behind. And we can measure also the improvements over time that we're achieving on the ground.
So primarily it's all real assets,
agriculture, forestry. Those are the main parts of the strategy. Yeah.
And what is your average ticket size?
It depends. It's probably between 30 to 80, 90 million.
And you have a target return that you shoot for?
We do. So it's an 8 to 10. So it's a real asset. Yeah, normal real asset return.
Can you give me an example of the nature-based carbon strategy?
Just as one, it's a very different activity. So there we are not looking for an investment return in the form of a financial IRR, but what we are trying to do is to help the projects to get off the ground in order to generate high quality carbon credits. And I think one of our best examples is we're working with an organization in Kenya, Malawi, and Uganda called the Global Evergreening Alliance. And there we're actually installing agroforestry techniques with smallholders on the ground. So they're an organization that works with local implementation partners. They've been doing this already for quite some time and showing that mainly by planting trees, they can improve the livelihood of smallholders because with the tree cover, they can actually start to grow other things and they have a much more nutritious ground than they had before, which is also more resilient to drought. So it's a great impact story. We have some very wonderful individual stories, how it improves the life of the underlying farmers. But for us, most importantly, because we're planting so many trees, we're also having a significant CO2 reduction that we're getting certified. And then the certified CO2 emissions we can deliver back to our investors.
So in these cases, you're investing money in acquiring this land and planting these trees.
We are not buying the land there. We're working with the local owners of the land, and we're basically saying it's a contractual arrangement where we're saying we're providing you a prepayment for the carbon, and for the investment we are making in your project, you're returning us X number of carbon credits over a certain time period. That's how we deal there. It's too complex for us in order to buy the land there. And also it's not an investment strategy where we want to benefit from any value enhancement of the land. We actually don't, we're very happy just to receive our CO2 certificates.
So it's a contractual relationship with the farmers?
Yes.
And so you have the ability to enforce and ensure that these forests don't get chopped down and so forth?
Sure. So you have, of course, contractual obligations that the counterparty has to fulfill, and there are also some remedies in case things are not happening. But ultimately, if the contract works as per plan, then it's almost like a self-exiting investment in that sense. We're providing the finance up front. We are getting a stream of carbon credits. Once that is delivered, we're out of the project. And the local community maintains the land and also maintains a future stream of carbon credits, which is very important for us because we actually want the local community benefits from these projects. So it's an ability to kickstart the project, to get a certain percentage of the underlying carbon credits to finance that, but to keep the control of the project and also the majority of the benefit with the local communities. That's very important for our investors because of this is the way they want to engage with the underlying project.
And then the revenue is the sale of the credits. Do you have a trading operation?
No, we don't, because we are working with corporates that actually want these credits and need these credits over time frame. So we're working with some of the investors that publicly announced that invest in our fund, includes GSK in the UK or Kerry in the US. They basically already today have their own net zero targets and know by when they have shortfalls and would like to use carbon credits. That's not today, that's probably in the future, but this is a 15-year strategy. So we are helping them to then receive these credits and they're using them for their own compliance needs. So there's no trading involved in there. So it's a strategy that directly helps corporates, and the corporate funds are used to kick these projects on the ground.
And what is the target return for this strategy?
Well, so we agreed with our investors on a target price, and instead of having an IRR, the way you probably know it in a fund, what we have is for a certain, we basically agreed with them a number of carbon credits for a certain amount invested in the fund. That's how we work.
Now for the $64 million question, how are these two strategies interlinked?
I think there are two different ways in order to find a way to pay for nature improvements on the ground. I think that's how they are interlinked. And I think they're by design not interlinked, because as you know, if you're running two strategies for different investors and they're exactly the same, the investors will get very upset about it. So here we have it's actually a really nice setup in that sense that we're saying we have a real asset, developed markets, investment opportunity for an institutional investor, and we have an emerging market, almost like a more procurement product for compliance buys. I think a lot of the techniques we are using, how we're investing in the underlying projects, how we're pricing carbon, how we're assessing the environmental risk around that, how we are measuring the impact, they are nearly the same for both strategies. So for us, we have a lot of synergies between the teams, and we can use a lot of our experts for both strategies. But ultimately, they are distinct and by design distinct investment opportunities for different types of investors.
What is your investment process for each of these strategies? Can you describe to me how logistically or tactically or operationally you identify your investment targets? What makes a strong nature-based investment for you?
Sure. I think a strong nature-based investment has to achieve both the expected return and the expected impact. And so we're taking a lot of time and energy on assessing both aspects. So it's not good enough to saying here's a really good, for our natural capital strategy, here's a good opportunity just to achieve a high IRR. What we always say is like, okay, so what's the theory of change? How do we create impact? And how can we make sure that we also hit the target return for our investors? And on the carbon side, it's similar. We're looking into that, okay, we're not only looking for cheap carbon credits, but we're also having an impact framework that needs to be fulfilled. We are looking very closely on how is the local community engaged, who owns the land, who benefits in the end, how can we make sure that we not only achieve the carbon emission reductions, but also leave a sustainable project afterwards and have additional impacts on the ground. And I think, generally speaking, I think the philosophy is that we want to engage in investments where, in really simple terms, where we leave the land that we found in a better shape than we found it.
Is there a specific example that you could describe how you became aware of a certain company that you ultimately invested in? And also, are you getting pipeline from pollinations activities, or is this just free inbound?
Both shareholders, wherever they see an opportunity, they will pass it on. As you can imagine, they have an interest that we find as many projects as possible, but we're doing generally, we're standalone, so we're completely independent, so also doing our own origination. An example how would work works. So for example, with an academia project, that's the underlying project partner that we're having is one of the experts on macadamia in Australia, and they were introduced to us, I think, very early on in our time as climate asset management, and we were not really able to transact at the scale at that point in time. And so for more than a year, there was no communication whatsoever. And then at some point, they came back and say, look, we heard now you advance in your fundraising. We have another project in another region. We would like to work with you. And then it's basically very quickly, you sign an NDA, you receive information, you're down there on the side, you look at it, you start assessing, building your internal models. And then you're also starting very concretely how you would work with the implementation partner on the ground. And that then, once you kind of set that framework, then you're ready to start negotiating commercials aspect of that. And then I think you can move to contractual negotiations.
And with natural capital, are there key risks that you take into consideration?
Well, absolutely. So once you kind of made your assessments, built your models, then you need to start checking, right? You know what is there. So you do a very deep due diligence. One of the first things we do, and I think, again, that's mentioned on your podcast quite a few times, is we obviously want to improve nature, but nature also is one of our biggest risk factor, right? If we're doing an agriculture project, droughts, too much rain, too little rain, fires, all these things are obviously a huge risk to us. So one of the things we're doing is the first step is also to run a climate model because we have a 15-year period to see whether from a climatic perspective, this is actually an activity that we should be able to do in that region. So that's kind of the first lens that you do. And it's interesting what you sometimes find, right? Sometimes it's advantageous even if it gets a bit warmer in a certain part of the world and you're expecting that for certain activities, sometimes it's a real problem. Then I think on the agriculture side, one of the huge risk factors is access to water. So it's having secure water access, being able to use it efficiently, but to use it is obviously one of the key. And then if we do a forestry project, it's things like forest fires and other natural disaster that could be there. So I think those are the kind of the key risks that we assess.
Do you have enough data now to know that they're proving to be reliable?
On the high level, you have some very good indication. You just have to go. I mean, it's all going back to the IPCC, which is this big scientific report that is published every 6 years or so. So I think you have a lot of data in there that you can use. But is it 100%? We don't know, right? We can't, of course, 100% foresee the future. But I think you have now quite a bit of data that you can use in at least to take an educated decision whether you need to. Well, you can do you can do an activity, or at least if you have a risk, and then you can see, can I mitigate that risk in some shape or form?
Are there risks that your investors are exposed to other than the same general market risk that all investors have with any investment?
I would say that, of course, there's a certain regulatory risk that they're exposed to, especially on the carbon side. The voluntary carbon market is not really regulated at the moment. So there's a risk, of course, for them that changes to underlying frameworks in the countries, how you can generate, for example, carbon credits, that could change. And that's obviously something that a lot of investors are looking quite closely at.
Your carbon-based strategy seems to be mainly focused on developing markets. Does your due diligence process change when you're focusing on these less developed economies?
In principle, you do the same elements. You have to do a good due diligence, and I think what changes it is sometimes a bit more complex to get the same type of information. So I'll give you one example. Land title in some of the emerging countries is much more complex to assess than, for example, in some developed countries. But ultimately, if you follow the same rigor when what you're doing, but I think the biggest difference is really, can I get access to the same data for some of these investments that I can get somewhere else?
How about corruption in some of these markets?
Yeah, of course. So that's also part of that. So that's a big assessment. But actually, compliance, I would say, is a huge part of our assessment in all of our investments. I think, as you can imagine, with our shareholders, that we take that very seriously.
So when you have impact on the company shingle, obviously measuring and managing impact outcomes is what it's all about. What are the key performance indicators that you watch? How do you measure your impact?
As I mentioned earlier, so we developed for both strategies an impact framework that we're using. And so we are looking for example, on our real asset strategy, we are looking for biodiversity, for CO2, for water, and what we call natural social improvement. So we have different sub-indicators there. And so we're trying to assess for each project, what is the most important impact indicator for the project here. And we start off baselining the project. So what's the situation at the moment on the ground, and what are the indicators that can be improved over time? And then we're measuring over time against that baseline. So for example, on biodiversity, it really can mean that we're in the field and counting certain species or certain plants and monitor this over a 15-year time period to demonstrate that we can improve that.
To what degree do you risk experiencing impact washing? Is this even a thing in the natural capital investing space?
I actually find that the investors we're dealing with, they're pushing us actually very hard to make sure that what we present as impacts can be quantified, or at least that we have very good information before we comment on that. And I think that has changed a lot. So there's always this notion, oh, the investors don't really care about this. Our experience has been the ones that invest with us, it's actually the opposite. They're going the extra mile, and they want to make sure that whatever we're collecting on impact data, that they can actually use that. And some of them are even required now by regulation to do that. So for example, the French investors, they have the Article 29, which now requires them to both collect climate and biodiversity related data. So they are not taking this lightly then in a way. So there's a real regulatory obligation. I think that's one of the, you asked, like, what is kind of the risk that many investors are exposed? I think they are seeing that they are exposed to more regulatory disclosure requirements over time, and they want to invest in opportunities that can provide them the necessary data. So we're spending an awful lot of time discussing with that what the format is, how we're delivering that. And I think that's, for some investors, also a key driver to look at these investments, because what they're realizing is that if you go into a real asset investment, you go all the way to the ground and you have the raw data, and unless in some listed equity funds where it's very difficult to get the appropriate impact data.
Once you make an investment, how much involvement do you have with your investments? Do you allocate capital and let them run and count on your due diligence to have identified a really strong team and all that? Or is there some hand holding usually?
There's hand-holding, and the asset management is one of the most important piece of the investment process. So initially, the investment team does the analysis, does the structuring, does the due diligence, closes the deal, but then it's handed over to the asset management team. We are working in all of our projects with local implementation partners, but the asset management team is overseeing that, making sure that the contractual arrangements that we're having with the underlying implementation partners, that they're really fulfilled. And that's a full-time job over the entire 15 years time. And that's also where we make sure that either the return or the in-kind delivery of carbon credits is happening.
So a lot of natural capital investments, by definition, a long time horizon to generate impact and returns. How do you ensure that you're investing in businesses whose impact will be preserved long after you've exited and comes much further out in the future?
In order to exit, we need to demonstrate that there's a long-term business. Otherwise, nobody would be willing to pay for it. And we get the question a lot. I don't know whether you're alluding to this. What if somebody just kind of goes in and then forgets about all the impact? But we think it's actually, that's a very unlikely scenario, because why would somebody pay for 15 years of impact creation, then come in and saying, I'll stop all the impact side and I'm just focusing on returns? It's a very unlikely scenario. And we do think that in particular, the large institutional investors will want to look for these opportunities going forward. But we need to make sure that we can show that. On the carbon side, it's a bit trickier, because we in a way we're self-exiting, so we are out of the transaction. But there, from day one, we want to make sure, and this is part of the investment philosophy for each transaction, that the local community maintains the project and also receives the benefits from additional stream of carbon credits going forward. That's very important also to our underlying investors, that we can demonstrate that for each transaction.
I want to discuss about an investment vehicle that you have with Apple, which is part of an extension of the Restore Fund. And if I understand it correctly, the idea is that this is working to allocate capital towards nature-based investments. Can you explain what this is and how does it actually work?
Yeah, when I said we have 3 vehicles by 2 strategies, this is the third one. And what Apple is, they are exposed to both of our strategies. So on the one hand side, they're investing in return, let's say the real asset side, in order to generate in the return. And on the other side, they're receiving carbon credits through investment in carbon projects. And what we're doing for them, we're putting this together in one vehicle and also in one reporting framework so that basically they can see the investment in carbon credits as a real investment and not just as a cost. So in really simple terms, the return from the real asset side is paying for the carbon credits, and we put this together in one vehicle. There's a really unique way of looking at it because a lot of the corporates struggle with investing in carbon credits because ultimately it's a cost. There's no, at the moment, if they don't sell the carbon credits but use them for themselves, it's a cost activity. And so what we're doing there is we're helping them to make sure that this is actually an investment activity for them.
How did this come about?
That's, I think, the philosophy under the Restore Fund, that they want to combine these two elements. And I think in a way we've seen that not only there, but other corporates are trying to find different ways how they can invest and receive carbon credits. You see this also, there are a lot of forestry funds in a way that are now in the market. I think you had Charlotte Kaiser from TIC last, it one of your last podcast participants, and they practically do the same, that they're saying you can invest with us in a forestry project and you can make a return from the sustainable harvesting of timber and also receive some in-kind carbon credits, and you can elect to that. So it's very common now that some asset management offer that for different investor types. And where we are different is that we're not saying we're doing it within the same project or the same project portfolio, but we're actually combining two project portfolios to have the same outcome.
The focus of this fund, it's not just for Apple, but it's also available for their suppliers. Is that true? And if so, how does that work?
That's correct. So they invited some of their suppliers to join. And the idea for them is to saying their suppliers are their scope 3. And the scope 3 is by definition the scope 1 and 2 of the suppliers. And that's one of the biggest problems we have now in our net zero world, so to speak, right? That my scope 1 and 2 could be your scope 3. So who's responsible for it? Are you responsible for your scope 3, or am I responsible for scope 1 and 2? And I think Apple tried to solve it by saying, I'm just inviting some of them in the same vehicle. They're using their scope 1 and 2. We're using our scope 3. And we can clearly show that this is actually an innovative way of combining that and not seeing as a conflict, but actually working jointly together.
What impact is this having in practice across Apple's supply chain?
Well, I think you have to ask Apple to do that, what it has. But I think, what I will say is that it's interesting that if a corporate, and this is not Apple, but we see if a corporate makes a clear statement that they want the supply chain to act, then actually they start really acting. So I think and Apple is not the only company there, right? So I think it's important that these big companies actually address it. Otherwise, change is not going to happen.
You've posted frequently on your LinkedIn about how such a small portion of global AUM is actually invested in nature-based solutions. What needs to change to encourage more capital to flow into this space?
It's a good question. It's one of the things I find puzzling because we have a lot of discussions with a large group of institutional investors. All of them want to talk to you about nature. A lot of them have very extensive internal groups that try to assess. They understand and they openly say, yes, we know this is something we will have to deal with, but we can't get our head around it. And one of the key things is that they can't find the right allocation for how they should invest into that. And the big question there is natural capital an asset class? Is it a sub-theme of real asset investment? Or is it a sub-theme of forestry and agriculture investment? Is it something standalone? And then that hinders a lot of them to get their head around. And then there's another group, I would say, that actually hasn't invested, at least not in a direct way, into agriculture and forestry for them. So that's also a big step to get into this area.
Have you found the differences between investing in nature with private rather than public capital different? And what are some of the key similarities? And what are some of the big differences?
Firstly, I would say there's always this notion that the public sector is investing for no return, and that's not true. Any DFI or MDB needs to make a return because they're issuing bonds every year. So to some extent, I find sometimes that actually the public sector is probably much more or much clearer that they need a return. And there's sometimes that makes them sometimes very conservative. I think where the public sector can overcome investment risk is when they're using truly governmental funds and when the funds are designed to leverage in private sector capital, because then these funds can take risks that nobody else can take. I think that makes a difference. But otherwise, I find actually at the moment that the private sector, in particular the corporate sector, is much more innovative in finding ways of investing in these type of fields, and also much more willing to take risks that nobody else is willing to take.
More and more natural capital investment strategies have appeared on the market in these last years, and there starts to be some visible momentum I think we've all seen over the recent past. How do you think this space will look like in the future and say, I don't know, 5 years or 10 years or 20 years out?
My hope and my view is that there will be much bigger allocations from institutional investors for mainly agriculture, forestry, around natural capital. I think we will find different ways to price biodiversity, which is the missing link at the moment. So all the things I described to you now, the biggest challenge at the moment is that we're actually using relatively traditional ways, agriculture, forestry, in order to create a value around nature. I think where we need to head to is that we also can price some of the value that biodiversity or the services around biodiversity can create, and that we can price them in, and that will allow them to build completely different financial instruments.
But as a percentage of AUM, it's relatively small.
It is relatively small, right? So if you look at the numbers, we have 100 trillion of GDP, roughly 4 to 5% is linked to agriculture and forestry activity. At the moment, I think we are not, a very, very, very small portion of that is actually invested. So I think there's a lot of room for increasing allocation in that space. And I think also the other way, I think in order to also price in biodiversity or other natural capital aspects, we would need a lot more measurement technology. So I think there's a lot of technology that can help us to do that. So I think it's not only, if you ask me, natural capital is not only a real asset in investment. That's obviously one opportunity, but I would see that it will be much more integrated into also technology investment. I think the next phase will be growth investment in that space. I think the private equity sector will wake up and see how supply chains and other companies are linked to nature. So I think that will allow to actually put much more capital into this field. It's similar to what we've seen on climate. So I think what I always tell people is 15 years ago, if you ask institutional investors, like, what are you doing on climate? They say, yeah, climate is a really big problem, but I can't invest in it. And fast forward to 2024, I think now it's seen, you just have to open any research report, it's the biggest investment opportunity around. So, and I think we will advance in the same way on nature, and will become clearer to investors where the opportunities are.
Most people have heard of Federated Hermes. It's a huge global asset management firm, but there may be listeners who are not familiar with it. So maybe you can just give a high level overview of Federated Hermes. And then I want to drill down on impact and sustainable part of the business. So maybe you can kind of talk about that and then drill down on your current roles and strategies and funds there. And I guess I really want to know also how impact and sustainability investing fits in overall at Federated Hermes.
So it's a US, UK based asset manager. The headquarters are in Pittsburgh. We have about 770 billion of assets under management. But in addition, we also advise through our stewardship service on 1.8 trillion of assets, where we engage with businesses and we set agendas in terms of environmental, social, governance KPIs. And we engage on behalf of global pension funds, endowments, charities. So in terms of what we do, London is kind of the hub for sustainable and impact investing. And that's where the expertise lies, in the Hermes part of the business, which is known as the leader in responsible investing. They've actually invented what today is known as stewardship and coined the word engagement to explain to investors what it means to engage with a company for better outcomes. My role is as head of impact and sustainable investing, and I'm responsible for the product under this strategy, as well as thought leadership. So if you look at London, I mean, all of our assets have whether you want to call it ESG integration or sustainability considerations that are on the fixed income equity private market side. And the same goes for the US, especially for the fixed income business, where we have 100 billion in AUM.
So you're primarily working on public debt and equities.
Yes. I look at the public markets.
I found somewhere that you are the portfolio manager on the Federated Hermes Biodiversity Equity Strategy. Is that true?
So it's a fund that was launched a bit in March 2022, and it is the first biodiversity champions fund in the equity space. And what I mean by this is when we started looking at the space, the first thought was a transition fund, but then you realize that literally every company on the planet needs to transition. So what we decided to do is find those companies that are actually already focusing on biodiversity, the so-called biodiversity champions. And we put two main criteria into place to identify those businesses. The first one is that the business needs to align to at least one UN SDG. And the reason for this is that 80% of the UN SDGs depend on biodiversity. So as you probably know, we keep on reading about it's only 5 years away to 2030 goals on UN SDGs, but we've only achieved less than 20%. Well, one of the main reasons is that you do need biodiversity to be taken into account. And the second one is that the company needs to help preserve or restore biodiversity. So if you look at the global market cap, which is almost 9,000 companies, which is, the usual MSCI all world benchmark against which we get benchmark, we found about 150 companies that are biodiversity champions. So that's not that many, frankly speaking. Obviously we apply exclusion lists to that, but companies that are really taking biodiversity into account, either as a part of their risk management, so supply chains, or as a part of their strategic decisions, are far and few in between. But thanks to the TNFD, we are seeing this change. Everybody was looking for some sort of guidance. And, we are hopeful that this positive trajectory in terms of adoption of TNFD is going to continue.
Did I understand you correctly that all of the strategies have some responsible investment angle and sustainability angle to it?
Everything in the shop has some angle to it. It's to varying degrees. So, the strategies that are directly under my umbrella obviously have a very high bar. So if you look at the impact strategy, that's really the highest bar that you can have. It's almost an approach of patient capital investor. We only invest in companies where we can prove in a quantifiable way the delivery of positive impact outcomes. We also take into account double materiality for each one of our businesses. Then we have a sustainable fund, which, brings together three types of companies, the so-called ESG leaders, the impactful businesses, but also companies that are improvers, where we tend to engage a lot. Then you have the biodiversity champions, which are really the champions. And then, if I look on our fixed income side, all of the products have some sort, if not quantitative, at least qualitative sustainability screens that are applied to them. Our real estate business on the private side does the same. Our infrastructure business and our PE business does the same. So for PE, climate change is something that is very important, but they also take into account a number of other ESG factors. Our real estate business is actually coming out, so they already have a whole so-called code of conduct for the companies that they work with, and they will be coming out with their comprehensive biodiversity strategy this year. So to varying degrees, every single vertical within the company has sustainability as a part. of the investment process.
You mentioned primarily 4 major asset classes. Could you ballpark the approximate allocation between public equities, public debt, private equity, private debt, what the split is roughly?
I mean, if you take out the money market business, the split is about 50% fixed income and then 40% equity and 10% on the private side.
What about the target returns?
I mean, we don't have a target return. We're trying to outperform the benchmark, which obviously if you look at overall sustainable space has been quite challenging over the last couple of years because not only for sustainable, for many strategies, they don't have exposure to the Magnificent Seven, given the narrowness of the market and, such a high concentration of returns in 7 or 5 stock, depending on the quarter. But what we are trying to achieve is deliver positive outcomes for the planet, be it society or the environment, in addition to financial returns. And our view is that over the long term, the companies that we invest in will outperform because they're providing goods and services which are satisfying the most critical needs, again, being of the environment, of the society, and they're exposed to secular and scalable sources of growth.
Are your investors primarily institutional and qualified professional investors, or do you have anything that's accessible retail?
No, it's accessible retail as well. So institutional and wholesale.
What is Federated Hermes' theory of change for impact and sustainable investing? I know from speaking with your colleague, Mitch Resnick, on the fixed income side, that sustainability is very much integrated in almost all that Federated Hermes does, and that it's taken seriously.
So in terms of the theory of change, I think what's key for us is being able to prove theory of change, the positive outcomes that we are looking for. And in most of the cases, we believe that in order, and this comes really to impact investing more than sustainable investing, impact investing without a quantifiable outcome is not impact investing. So to that end, we have actually set up a proprietary impact database where we track every one of our holdings on an annual basis. So for instance, we have 23 KPIs. We look both at operations and solutions. Those KPIs are actually covering what we believe are the most critical E, S, and G factors. And, I'm glad to say that we have 4 years of positive delta for for actually all of our businesses. I mean, maybe there was some, small changes, but that was mostly due to COVID effect. And why this is important is that, we have full accountability and traceability for our investments. We can really prove that we are channeling capital to the businesses that are creating this theory of change, be it for the environment or with regards to society in the provision of their goods and services.
You're primarily focused on public equity markets. And a lot of people I speak with ask me about how can buying and selling publicly traded equities or bonds on the secondary markets, how does that impact investing when you're on the secondary market?
A lot of people ask me the same question, Paul. And the take is quite simple. I mean, if you're thinking about, how many dollars in terms of impact you get for your investment in the private space, it's quite easy to quantify. And there is this, the secondary market. But think of it this way. So every successful private company has an end goal, and that end goal is usually to do an IPO. So the way that I see it is we act as providers of permanent capital for those impactful businesses to grow. Second thing is, if you look at the access to capital, obviously in the public space, it's much larger than it is in the private space just by the sheer size of the markets. And in order to grow that positive impact, you need that capital. So I think we play an extremely important role in scaling up the positive impact in the market that goes beyond, just purely looking, well, what are you doing? It's, buying and selling shares. Well, it's not.
Let's talk a bit now about how you operationally integrate sustainability and impact factors across your different strategies into your investment analysis and decision-making processes across the various different strategies that you have.
I think the best example to give you perhaps is on the dedicated strategies, because that's where we have a very high bar. The other strategies will use qualitative and quantitative screens, and then we have engagement, which is super important. So we engage with corporates as a part of our stewardship service, but we also have dedicated engagers on the team. And that's also, part of the theory of change, to drive change through engaging with businesses for the positive outcomes. So let me give you one example of how we look at the themes that we invest in. So for instance, for our impact strategy, which really is the highest bar in terms of investment, we have identified 9 themes that are in alignment with the UN SDGs, which we believe really cover the most pressing needs of the society and the environment. So, it's food security, it's health and well-being, education, financial inclusion, future mobility, something that we call impact enablers, which are companies that are actually, enabling other businesses to be very impactful, circular economy and water. And if we take health and well-being, that's SDG 3, a very important SDG. It's a combination of thematic and impact investing, which is driven by us identifying what we believe are the long-term mega trends. So if you look at health and well-being, we have identified something that we call persistent pandemics, and those are the likes of non-communicable diseases, which account on average for 70% of the global death every year. And within those, chronic diseases have the highest incidence. And within the chronic diseases, diabetes, also known as the silent killer, accounts for almost 11% of global deaths every year. So what we look to do is get direct and indirect exposure to the theme. In terms of the direct exposure, the big problem with diabetes is that today you have over 500 million people that are suffering from diabetes globally. This number is expected to grow to in excess of 700 million in the next 30 years. The cost is already high. Just the direct cost today is more than $1 trillion per year. If you actually add the indirect cost to that, you can increase this by 30%. And one of the main reasons for the high incidence of mortality is the lack of a proper measurement and proper medication. So what we've done is we invested in a medtech company called Dexcom, and they're a leader in continuous glucose monitoring systems. And what CGM does, it gives you 24-hour monitoring of your glucose levels. So, majority of the planet still today measures their glucose levels by pricking their finger with a needle. That's inaccurate and untimely. And this is the reason why, you don't take insulin time and you have issues. So CGM gives you 24-hour monitoring. But, talking about the impact, positive impact, this is a company that's increased their sales from 100 million, less than 100 million, actually, 10 years ago to 3.5 billion today. And they've done this with only reaching 2.5 million patients. If you think of the global, obviously it's not, more than 500 million today. They actually say that their TAM is about 50 million people. But they have managed to not only improve the lives of diabetic patients, because what CGM allows you is to literally have a normal life. It's a sensor that tells you, when you're high or you're low, you should administer insulin. It also reduces the cost of diabetic patients considerably. So if you look at the United States, the average cost of a diabetic patient per annum is about $16,500. And through the use of CGM, you can reduce this depending on, your co-payment, etc., on your insurance scheme by about $5,000. So it's not only that they're helping to improve people's lives, they're also helping to reduce the healthcare budget, so this money can be used, elsewhere. So very impactful business. Once we kind of establish a direct link to our chosen theme, we start looking at, what are the indirect factors that are contributing to that particular theme. And in terms of NCDs, this always this view that, majority of them are genetic. Actually, they're not. Genes account for only 20%, and all the rest depends on your lifestyle, what kind of food you eat, how active you are, what kind of environment you live in. So to that end, we have invested in a company that is the US-based business that is democratizing access to gyms. We are also looking at, finding, which has been a bit challenging, businesses that are providing access to healthy foods or promoting that. So it's a very interesting space.
Your website says that your responsible investment strategies, you cover a full range of asset classes, and each of these asset classes have their own investment style and stewardship approach. Can you describe what are the key similarities and the key differences and the key challenges when you integrate your approach into these different asset classes? And then I might add that you're doing all this while still generating or trying to generate traditional financial returns in line with investor expectations.
So if we talk about what I said earlier, if you're running a concentrated fund and your remit really is whether it's impact sustainable investment, we go to a really granular level in terms of what we are looking for. In terms of investment, like our KPIs, the number of KPIs, 120. So the overlay is going to be more of a screen-based overlay as well as qualitative, which will be at the discretion of the manager. So I think the main difference that you have is between the type of the product, how concentrated it is, how it's not. And then if you take emerging markets, for them, obviously, a big focus is engagement with the companies, given that they are behind in terms of, that versus the developed world and in terms of, ESG, let's call them the ESG considerations. So you will have different levels of integration depending on the product.
To make it real, walk me through the end-to-end investment process when you're making an investment in one of your portfolios. Maybe you could pick one and talk through it, and what's your investment horizon, and then what are your financial and non-financial screens, or qualitative versus quantitative?
Again, if you talk about the impact product, because that's really the highest bar, we take the approach of a patient capital investor, and we're trying to capitalize on what we see as mispricing of the long-term change in the market. And this is that these businesses are not being priced correctly given future development, what we expect to be the future development of their revenues and their markets in terms of the total addressable market. And this will be driven either by the actual needs, whether it's in the climate space, everything that we are seeing around natural disasters, whether it's in the health space, in terms of the demand, the aging population, the obese population, prevalence of, on the financial inclusion side, the prevalence of, the need for financial inclusion globally. What we do is we have what I mentioned earlier, the database. So we have to be able to prove in a quantifiable way that this business has intentionality, actually wants to do impactful things for the environment, for the society. And the second one is obviously that what we are looking for is what is this business doing that is additional, that wouldn't exist otherwise? So what is their contribution? After that, we start looking at the financial factors of the businesses as well. And if you would describe the similar characteristics of our businesses, what you will usually find is that they're monopolies or oligopolies, or are leaders in a fragmented market, which they're actually consolidating. So very strong market positions. What we look for is usually that, we don't like very capital intensive businesses. So asset light, a growth both in terms of organic sales, maintenance of margins or increase in margins. We look at the ROIC to WACC spread, high free cash flow generations. So those would be some of the financial considerations that we take in place. And then in terms of the actual valuation, given that we see ourselves as long-term investors, so when we think about business, we're like, are we comfortable owning this for the next 3 years with a view of, how do we think this will shape out in the next 5 years? So we run DCF for each one of our businesses, and we look at the best base and worst case scenario, and we are quite conservative in terms of the terminal growth rates that we apply to the businesses. So this is how our investment process shapes up.
So Federated Hermes invests from both a best-in-class, but also from a transition perspective. How does your investment allocation process differ between these two concepts?
So if you look at the transition, that is the part of those portfolios are really looking to engage with businesses and help them improve their transition. So it's very hands-on in terms of, communicating with the companies, setting targets, monitoring those targets, sharing what we believe are the best practices. We have a very, very extensive engagement framework. So that would be the main difference. So the business is what's interesting. So if you look at the impact fund in terms of the engagement, for us, environment is less than 10% because these businesses are so advanced in terms of, where they are on the transition scale. And then with improvers, the environmental part, the E part is going to be much higher than the S or the G part.
Are there key KPIs that you track to ensure that your impact performance is in line with the expectations you had from a sustainability perspective?
So if you look at, for instance, on the environmental side, what we look for, obviously, it's the emissions, it's water, it's waste. For specific industries, we'll also look at food waste that they help to avoid. Then for pharma companies, we'll be looking at, number of patient lives saved. On the S side, we'll look at the usual, the breakdown, the board composition, the number of minorities that are employed. On biodiversity, we'll be looking for how much land company has helped preserve from conversion, given that land conversion is one of the biggest problems that we have today, given that 50% of land on this planet is already used for agriculture. So we are constantly losing our natural carbon sinks due to conversion. And it's not a very efficient conversion. So we track a number of KPIs. Do you want me to tell you all of the KPIs?
Well, it depends. If there's 65 of them, no. But if there's like key ones that you want to say, it could be instructive.
So I can give you some key ones. So, the annulus metric tons of CO2 emitted, megawatts of renewable capacity installed. Then we look at how much water a company has used and how much it has saved. We look at waste generated, but also waste recycled. So what I was saying earlier, everything is based on double materiality because we like to net out the effect. We look at employee turnover, the number of incidents. We look at, R&D as a percentage of sales. We look at, number of people that have been given access to nutritious food. What I said earlier, the hectares of land that a company has helped to restore or preserve. So those are some of the KPIs that we look at.
So do you believe you can demonstrate or have demonstrated perhaps that active management of sustainability risk outperforms the market over the long term?
If you're looking against the benchmark, that's a great question. We've gone through a very unusual period, which started with COVID, then the inflation and the biggest rotation in the markets that we've seen in the last 50 years, coupled with the biggest interest rates. So it hasn't been a very easy market to operate on. And if you look at our businesses, they are growth businesses, quality growth businesses, and that's something that's been sold off in favor of value. And the second thing that happened was this prevalence of 7 stocks, the Magnificent Seven, which have been driving the market, which is not necessarily the names that you would see in an impact or more in an impact portfolio, because they wouldn't pass the threshold. So it's been difficult, but we believe that over the long term, and provided that the markets normalize, if you're looking on the benchmark, we should outperform given the type of the businesses that we invest in. And what's quite interesting is when you see a sort of a normalization in the market, which in the recent times has been mostly driven by the move in the yields, this type of products tend to outperform substantially.
Could you give me a real example of an engagement activity that drove impact and influenced returns?
So we were worried about a certain healthcare company that their products are, being misused, missold for unapproved labels, and copycat products, which were actually harmful to people, seriously harmful to people. So we engaged with this company and we were asking them, what they're doing to reverse this, what kind of powers they have within the company to actually remove the fraudulent product from the marketplace, what they're doing in terms of physicians' education on off-label prescriptions. And this was actually a short engagement, which was led directly by the impact team. We lasted about a year, and the outcome was that in their capital markets day, the CEO spoke about the heightened governance brought about these issues and that the improvements that they were bringing forward. And we know that the number of fraudulent products has been taken out of the marketplace, because that was not down to the company, that was actually down to the regulator as well as to the law enforcement. And we know that in terms of we've actually seen firsthand outcomes that in terms of the off-label prescriptions, those have been reduced immensely.
You are very active in the biodiversity space. And as we already discussed briefly, you're the portfolio manager for the Federated Hermes Biodiversity Equity Strategy. Is this the area where you see the most scope for impact and return currently? Also, where does biodiversity fit in at Federated Hermes?
So it's been a focus for us for the last 5 years, actually 4 years. We came out with a white paper called Our Commitment to Nature, where we have explained what our expectations from the corporates are. We have been very active both on the policy side and on various industry-led initiatives such as Finance for Biodiversity and a Nature Action 100. We cooperate a lot on biodiversity within the industry. And why biodiversity is important? Well, it's pretty simple. We depend on it for everything, whether it's the air that we breathe, our food, our water, our medicine. 63% of medicines come from plants. But we have a problem. And the problem is that in the last 50 years, we have decimated biodiversity globally. And there are only two reasons for that. And one reason is our consumption needs. The second reason is our energy needs. We have behaved very responsibly in that we have taken nature as something that is permanent, but nature is not permanent. It's just another resource. So the way that, you should be thinking about nature is the same way that you think about, copper, iron ore, all of the resources that are scarce. So we think that it is the biggest or one of the biggest systemic risks that we are facing globally in the next 10 years. On the other side, not enough attention has been paid to it to date. And what we have found is that companies are not taking it into account routinely, either as a part of their strategic decisions or as a part of their risk management. And we think that the repercussions of that will be huge, because the number of risks that we are carrying, on as a corporate is, whether you will be stranded with stranded assets, or you will not be able to get permitting for your projects, all of which turn into financial, the reputational risk on the supply chain side that, we read about on a daily basis. And then there are economic risks that are, the price of food, the persistent inflation that will come out of it, the geopolitical considerations, given that the expectation is that 50% of all the food will come from outside the country of origin in the next 20 years. So it's an extremely important subject for us.
Your Biodiversity Equity Fund was created 2.5 years ago. What is the interest in it, and what's the AUM of this after a couple of years of operation?
The AUM is just under 50 million now. It's an emerging asset class. If you look at the AUM in biodiversity space, they've increased 6x over the last 5 years, but it's still very small. The funds have only started to be launched over 2 years, the last couple of years. And actually, if you look at, the interest from asset allocators, that's something that has been emerging since COP15, which was a year and a half ago. And there has been a very long educational process around biodiversity and, what's the best way to approach it and, what are the investable themes around it. So it's a very young asset class.
You're an expert member of the International Advisory Panel on Biodiversity Credits. Explain the biodiversity credit market would look like and how can it work?
It's early days in terms of biodiversity credits, but it's something that is very necessary, whether you're thinking about conservation or whether you're thinking about restoration. What we're trying to deal with the issues around it, and the issues being, when it comes to the carbon market, you have a single metric. Here you have a number of metrics. And the second thing that you have is ecosystem. Ecosystems are localized. So you have to think of how to apply that on a global scale as well. You have to think about a number of different issues, how to make it, tradable and scalable, which is important. And those also include, the buyer-seller relationship, how that will look like, the actual permanence of the project itself, likes of, natural disasters that can affect the project and indirectly the credit applied to the project. So there is a lot to consider, but we are hoping that we will come out with some sound principles on how to develop this market later on in the year.
What's the major obstacle?
Single unit, and that it's localized. When it comes to the carbon market, it's a single unit and it's the same globally. Biodiversity is local, and there are, millions of units that need to be considered.
So maybe we could start with an overview of the GFI, and you can tell me what it is, and maybe go back to the beginning and describe the origins of the GFI, and then what's the present day mission and how's it structured and your particular role there?
The UK government had a green finance strategy. It's now on its version 2. But one recommendation within that strategy was to set up an institute like GFI, and it ended up being GFI, that would really work on those barriers to allowing the flow of large-scale capital into net zero investments and nature positive investments. Or nature was sort of a bit of an add-on. Even 5 years ago when GFI was set up, natural capital wasn't really part of the debate particularly. So it was seed funded by government and the City of London, although now predominantly we are funded philanthropically, so we are a not-for-profit. And we work very much on a focus of, we work with the finance sector, the commercial sector, so businesses, academia, the third sector, to understand what the barriers are to the capital flowing into the decarbonisation of road transport, for example, energy efficiency of built environment across the UK, sustainable aviation fuels, carbon dioxide removals. We sort of see where the gaps are, and then convene various sectors together, so cross-sector convening to understand what the barriers are, and then co-design solutions. So in sectors like decarbonisation of road transport, there are products that you can build with the financial institutions that can allow money to flow. And in the built environment, for example, it's green mortgages. And some of my team have been instrumental in building the green mortgage market in the UK. So we do work very closely with the finance sector and helping co-design those products and really just elevating those out. It's very different in nature because it's so nascent that the idea of financial products around nature restoration is still quite far off. So the nature team, we're 7. We tend to focus on what are some of the policy barriers that we can start to work through, or what are the building blocks that we've seen in climate that we can start to replicate in nature that will get us to a place where ultimately we'll have products, funds that can actually move large amounts of capital into nature restoration.
Describe the GFI's theory of change, and since you're the director of the GFI Hive, which I guess, is that the nature part? I don't know.
Yeah, that's our nature team name, yeah.
Explain specifically what is your theory of change for nature positive outcomes, if that differs in some ways from the overall GFI theory of change.
There are 2 challenges we're trying to solve for at the moment. One is we need to get money out the door as quickly as possible into nature restoration, so we bend the curve on biodiversity loss, which is of course compounding with climate change. We can talk about that later and how that's not captured. So how do we do that? There are certain instruments that allow for that. Nature markets, like nature-based carbon markets. There's biodiversity net gain, so compliance markets that exist, mitigation banking. There are some supply chain models, but these are sort of things that you can get going fairly quickly, depends, and get money out the door now from the private sector into nature restoration, or certainly reducing impact and hopefully having a net gain, positive impact. So we work a lot on what are the underpinnings to create nature markets, what needs to be done, so the supply, the demand, the market infrastructure. And then the other piece is what we need to do to get the billions and trillions flowing is embed nature, sort of transition to an economy really that values and invests in the natural environment. And that is a trajectory that we might have seen with climate, where you had TCFD, and now in nature we have TNFD, which we host a secretariat for, the Task Force on Nature-Related Financial Disclosures. So it's like you start off with getting companies aware of their risks and their impacts on nature and disclosing them. Then you'll build taxonomies around them, so you can put some guardrails around what investment in nature restoration is. And it's sort of that trajectory that's a much longer trajectory, one that we need to take. So I guess the theory is that we need to get private sector capital moving. We can't rely on the public sector alone. And so we're just working on these 2 kind of pathways to making that change.
Give me a definition of natural capital, or sometimes referred to as nature-based capital, and explain to me, why should this be important to investors?
The way I think about the challenge is said we're focusing on climate, but we're really just focusing on carbon emission reduction. It's a shame that ultimately we didn't start with the natural environment, of which climate and carbon is a subset, a very, very important one, but a subset. We've gone kind of the other way around. So what we've missed in our whole climate finance journey is that nature degradation compounds with climate risk. So if you have a drought and your soil health is poor, you are going to have a worse drought, which will make your soil health poorer. And so it goes on. We haven't captured any of that part of the equation in our climate risk analysis. No central bank has yet either. So we are under an assumption that we have a certain level of climate risk that is completely underestimating the level of climate risk we actually have, because we've ignored nature. So that's kind of nature just as part of climate, just to try and get people's attention that if you think you're doing climate, you're not, if you're not capturing nature degradation as well. And the soil health is just one example. So that's one reason, like, we're not capturing the risk. And then the second, which is just an obvious one really, when I think of natural capital, it's all the things we're missing. So it's plastics in the ocean and other pollution of our oceans. It's water quality that we're destroying at the moment. It's also water shortages through some of the actions we're taking on land, how we're increasing flooding by not taking care of the environment of a lot of landscapes, through the things that would absorb water. There are just so many different parts of the natural environment that we're not capturing at the moment. And we call it nature. And the pushback we get from lots of billionaires and asset managers is that it's so wishy-washy. And it kind of is, because nature is like everything. It's our entire planet. It's you and me, we're part of nature. And so people find it quite hard to define. But if we don't invest in what's called our natural capital, so our forests and our soils, then we have no planet. So it's a bit of a no-brainer, but getting people to kind of understand that we need to invest in our natural capital is really quite challenging at the moment, because they say, no, we're focused on climate. I say, you're not focused on climate, you're focused on carbon.
What is the problem or the problems that the GFI is trying to solve, and why do you at the GFI need to focus on the nature space? I feel like I'm trying to pick up a fish here.
We are, as I say, a not-for-profit, and we are entirely neutral, so we benefit from that. We work with government on some pieces of work. We advise government, like others, but we can also speak the language of the finance sector. My CEO came from Barclays Bank. Many of my colleagues came out of banking. So we're able to have that conversation and kind of sort of look at policy, look at what's happening on the ground, but also look at finance. So that's why I think we're in a position that we are. On nature, there aren't, although, even just in the 4.5 years I've been with GFI, there weren't many people at the time who could thread the needle. You had NGOs who worked on nature restoration and conservation, and they got money from grants and donations, and that's what they did. And they didn't think in terms of what am I doing for business in terms of restoring nature? Should business be paying? If I'm restoring watersheds, shouldn't business that benefits from the improved quality and amount of water, shouldn't they be paying for watersheds? So we're able to sort of have that conversation. So one of the things we've done is really work with essentially the supply side, which is farmers and land managers and NGOs, in trying to help them think through how could you attract private sector capital into what you want to do in terms of nature restoration and conservation. In the UK, there are 2 investment readiness funds that were set up by Scottish Government and then by DEFRA in England. And they pay grants to farmers and NGOs and land managers to help figure out what kind of business case could I have here. So could I sell carbon sequestration and carbon credits? And would that money then help me plant trees, for example? And can I improve this habitat and sell into biodiversity net gain units to a property developer? And we have worked with the supply side on that journey and developed toolkits to help them think through, because it's a whole new language for them to think about that. So it's a bit of a shift in mindset. And then we work with companies to help them understand, because they say, what's nature got to do with my business case? Like, I can't convince the boards that nature's important. So we've done lots of research and analysis, and we work very closely with the TNFD, because we host the Secretariat and run the consultation group in the UK, to sort of talk to them about what is your business resilience impact from nature degradation in a landscape. Maybe it's that the compounding risk with climate means that your workforce will reduce.
Where is the value in a natural capital strategy? Because I suppose people are looking somehow to quantify or look for return. Where is the value in that when you're trying to crowd in private investors?
So if you're an investor in any company, you're looking for a company, I would think, that is going to be resilient and that is on top of its physical risks and is adapting for them. And the truth is that most companies aren't looking at their natural capital risk. If you are a water company or a beverage company that's reliant on water, yes, you probably are. And if you're an energy company that is, or some of the tech companies we're seeing in the US are really aware of the amount of water that they're using and how they're going to have to replenish some of that water. So there is an awareness growing of businesses that we can't just keep taking from a natural environment. We've got to start putting back in, otherwise it's going to affect our businesses. Our argument is that if you don't know what your impact and your dependencies are on the natural environment, you don't know that your business is going to survive. So the Task Force on Nature-related Financial Disclosures is a global framework that allows companies to start doing that analysis of like, okay, where am I located and what's the impact on natural capital that my company is creating, but also what are my dependencies. So if you're an investor and you're investing in a firm that isn't doing that, you're investing in a firm that doesn't know that it's going to be around for the long term. And that is a huge risk. And the finance sector really understands that, especially on TNFD. We've worked with tons of asset managers and banks who really understand the fact they need to work with their clients to understand that level of risk. So that's one thing I think is really clear. On where is less clear, I think, is where is the sort of opportunity side? Like, what can I invest in? What are the companies of the future? So, you might think about precision ag. If we're going to move to a world where we actually really are going to reduce our nutrient load in soils because we need to improve soil health, and it's written in the Global Biodiversity Framework that we need to reduce nutrients. Should you be investing in those kinds of technologies and within larger companies in agriculture that are using those technologies? And that's possibly where it's like starting to be in the opportunity side. Some investors are more like, we want to set up a natural capital fund and own land, in which case you'll be buying land that is going to be restoring land and then selling carbon credits, which we anticipate the price of carbon credits to increase, the nature-based carbon credits. And there might be potentially a biodiversity type credit market down the line. We don't know. Or you just might be selling some of those benefits into businesses who want to shore up their own resilience at a landscape level. So there's an opportunity there, but I think that's a more challenging route to go because the returns aren't huge.
It feels like nature degradation and biodiversity loss are equally as detrimental towards climate change and global ecosystem instability as greenhouse gas emissions. Why do you think climate change and carbon has been more in focus while nature has been kind of a red-headed stepchild and taken a backseat on this whole global sustainability agenda?
I think it just got the attention first. I would really think about this because I look at what happened. Like, I often think, how did the Paris Agreement get done? And what you had there was you had very vocal people within the corporate sector, like Paul Polman, who was CEO of Unilever at that time, the IKEA CEO. They were pushing. China had gone through some natural catastrophes, and so it was based on climate change. So they were sort of more engaged in climate change, and you had Obama in there as well for some of that period, who was going to push for it. So you had these leaders across politics, like the global governments, the leading governments, and these leading multinational companies who understood and were pushing for it. Plus you had like an activist sector coming through that was really pushing for it. And you had the Pope come out and say climate change was important. So you had all this kind of these things happening at the same time. And on nature, one of the biggest challenges we have is we don't have that global personality in, a leader actually pushing for us to tackle nature degradation. And when we talk to philanthropists, they point out, like, there's no one here telling us what to do, why it's important. No one's pushing on this door on nature, and it's a real problem. And we talk about it all the time. Like, how can we galvanize as much interest for this incredibly important thing I mean, even if we tackle climate change, but we've lost all of our ocean, our oceans are poisoned and our waters are poisoned, what are we going to do? Like, it's crazy that we're leaving it on the shelf for the moment. I think there's just a lack of interest. It might be the politics has changed. Like, we've moved into a world where it's short-term thinking in voting, unfortunately. I'm not ever sure it was more than that, but it certainly feels short-termist now.
I've seen estimates that somewhere north of 1 trillion US dollars is needed by 2030 to restore and maintain biodiversity. I'm not sure I understand how those numbers are calculated, but currently global investment into biodiversity is something like 200 billion per year. Again, I'm not sure where those numbers all come from. What is the role of private investment in achieving nature positive outcomes?
So at the moment, as I mentioned, there's no real teeth for businesses. There's no real push and drive on businesses to actually pay for the natural environment that they use, what we call externalities, to pay for the cleanup that they cause, or to even just pay for what they're using. So we need to change that. But also we need companies to pay for the transition. So if you're a supermarket, and how can we get you and all those through the supply chain to help pay a farmer to transition to a nature positive or a nature friendly way of farming? And many farmers do farm in a nature friendly way. And how do we get that to be improved? Because farmers don't have any money, so someone's got to pay for it. So we really need them to pay for it. But I say we don't have any regulation demanding that our businesses start to pay, which also means if you're in the finance sector, you've got nothing to invest in because businesses aren't changing their practices. So we're in a really difficult situation. So one of the things we've been looking at with WWF UK is this sort of what we call nature positive pathways, which nature positive itself is a term that is also a bit challenging, because what does that mean? Nature gets so broad, and what's positive mean? But what we're saying is we've got a global biodiversity framework with goals and targets, and every country has been asked, who's a signatory, has been asked to create a national biodiversity action strategy plan to update it. So taking the UK as an example, we have it's an MBSAP, that's what it's called. And we have in England an environmental improvement plan with the Environment Act. So there's a bill saying all the things that we need to do with our environment. We've not said, what do we expect businesses to contribute towards those targets, whether it's our global targets or our domestic targets? We need to figure out what we're going to ask of a business. So we're saying, like we have in net zero, there is the net zero pathways, which can tell you what you expect each sector to contribute. We need the same for nature. We need to say, okay, when it comes to water quality, which sectors are the priority sectors that are going to have to step up here and hit some of these targets, and therefore they'll have to invest in whatever they've got to invest in. So I think without that guidance, we're never going to get businesses, because there's businesses say, okay, I do my disclosures on TNFD and I figure out what my impacts are, my dependencies. What do you want me to do? Like, what benefit is it to me to start to move unless I can see like a direct business case? Like, what is it? So we really need to start pushing on business to play a role here in meeting our global nature targets. And I think that's really the first step. So we're on a bit of a journey, and it's a journey that's going to take longer than a decade.
But if we're going to crowd in private investment, the private sector investment's all about risk returns. So explain how natural capital is investable. Or maybe you have an example or two of a natural capital investment strategy. And ultimately, if we're going to crowd in investment, what kind of financial returns are required to really get capital flowing? Because that's how the capital is going to flow in, is if there's a return. Otherwise, we're really back to talking almost like about philanthropy or grants and that sort of thing.
This is the challenge, I think. So there are several different approaches to getting capital moving into nature, whether we want to call it restoration or less harm than the other way around. So there's quite a few private equity funds, which again are investing in sort of those new technologies, whether it's, seaweed technologies or sustainable fisheries solutions, alternative plastics, precision ag, and some of the ag type of technologies. So those exist. On the kind of public equity side, I think it's very limited. Some funds will claim that they're investing in businesses that are nature positive, but there are very few businesses that are nature positive. Perhaps they're on a transition and that's warranted, but that is not a big area of capital. On the debt side, I think we will start to see more sustainability linked notes which have nature KPIs within them, and maybe expanding green bonds, or expanding them, but having more nature KPIs within green bonds. But again, businesses need to know what's okay as a KPI, what they should be aiming for. And then we have that piece which is investing in land, which comes with its own challenges, because, do we want land under ownership of large corporates, etc.? But that, and there are some lease models that are really good. But even those, unless it's sustainable timber or sustainable agriculture at a very large scale, which you can achieve in like the US and Australia, for example, those are quite hard to find the returns on that are the 12 to 20% that a lot of financial institutions are demanding. Honestly, in some of these projects, it's more like sub 5%.
You direct the nature program at the GFI. Can you walk through the areas that you're focusing on?
So we work on supporting the growth of nature markets within the UK. So in the UK, we have carbon markets, voluntary, peatland and woodland, and then some others being developed. And we have 2 compliance markets, biodiversity net gain and nutrient neutrality, which are just England. I mentioned the investment readiness funds that we've supported and advised Scotland and England on, and building that supply. And now we're trying to work with the demand side. But there's also a whole bunch of market infrastructure that needs to be developed, like standards. So we work on how those standards can be developed. How do they run well? What's the governance structure? We feed that into policy by convening groups and then feeding in. So that's kind of one piece. How do we get nature markets working? And now we have, we received some funding from the Moore Foundation to look at, well, can we take that kind of thinking internationally? Because every country that's signed up to the Global Biodiversity Framework is going to have a challenge of how am I going to get this money out the door? And nature markets offer a route, just one route to doing that. So can we showcase some of those models that are working, not just in the UK, the US has incredible nature markets, and see if we can work with governments to replicate some of those markets, which might take 3 years to set up the infrastructure for, but at least it's this side of 2030 that we start to get money moving. That's another part. And then we look at that really long trajectory of how do we transition the entire economy. So I mentioned we host the TNFD and work with probably over 700 corporates across the UK on how they're going to think about nature-related risk. We produced a report with the University of Oxford and University of Reading and other technical partners, UNEP-WCMC earlier this year, that actually went deep into actually what's the economic risk to the UK of nature risk, which was incredible. It's actually higher than climate. And we did this report to try and help prove to our central bank and to government, I think, sort of understand it, but to business, that nature risk is not something you can just say it's not relevant to me. It's actually something we should be tackling as an issue of systemic risk, and to feed into that global systemic risk debate that the NGFS is having, the Network for Greening Financial System. So that's kind of the second part. So those are, and then MPPs is the National Nature Positive Pathways is part of that. We have a team that works on a taxonomy that's not under me, but the green taxonomy and how nature plays a role in the UK green taxonomy, that's really, really important piece. So those are kind of the major pieces we work on. And then within that, we'll focus on natural flood management or biodiversity, carbon.
Why are these areas underfunded? Is it just because there's no standardized reporting on these risks or the negative returns of nature degradation? Or
from my recollection of when I started out covering stable finance back in 2010, was that everyone was banging on the doors of the big banks and saying stop funding fossil fuels, and they said, actually, there's no business risk to me at the moment because a lot of these are like 3-year, 5-year loans and there's no stranded asset risk in the next 3 to 5 years. So I'm just going to keep on financing it. And I think until you start to show that there is a reputational risk, a litigation risk, a physical risk, and what those risks are, you're just going to have business as usual. And I think in nature, we've just not got to that point where people really understand. I mean, yes, if you're, there've been cases of, as I say, a beverage company which has been sued for using too much of a water supply, or there's plenty of water utilities that are not doing great things with waterways that are under pressure as well and always getting bad press, and that impacts their their share price. There's some obvious examples, but I think people don't think of them as nature. I think it's such a strange word for us almost, nature, because it's just who we are. It's like, you know that thing where you say, trying to explain to a fish what water is, and they're like, what are you talking about? It's almost like that. We've got to kind of reframe our relationship with nature as being one that is here for our survival and our economic prosperity, which can feel a bit tasteless, to be honest, given like nature is something that's very soulful, and now we're talking about it in economic terms. But otherwise, I don't know how we start to move the conversation forward with business, because they don't think about it in soulful terms. As an organization, probably individually they do.
Who do you think holds the primary responsibility for natural capital preservation? And what can we do to get them to take the responsibility?
The ultimate responsibility is government, isn't it? Because they set the rules. They set the rules of engagement for business, and they have the oversight over an entire nation. So, they should understand what the natural capital account is, how that's been depleted, what is their framework for change on that landscape or marinescape if it's a seascape, and then how they're going to deliver it and how they're going to get the private sector to deliver it. And I think, we've seen governments sign up to the Global Biodiversity Framework. What we haven't seen now is them starting to figure out how they're going to get business to play ball. And that, I think, is going to be the sticking point of hitting those goals.
So do you see it as a political issue, or is it just a government ineffectiveness issue?
Is it a political issue? I think it can be when it starts to come down to, if you're going to make businesses act a certain way in your nation, then how does that affect you competitively elsewhere? It has to be a global approach, because otherwise it will be politicized. It hasn't yet. And I've always thought that what we've net zero is often focused on what's being taken away, what you have to give up your flying, give up your car. And so it can have a bit of a negative, give up your wonderful oil and gas, it can have a negative approach. Whereas nature is, people love nature, people want more of it. Why can't we have more of it? It doesn't make any sense. Why aren't we looking after soil health? I mean, it's just obvious stuff. So it hasn't been politicized at the moment, but I do think it could be, because it will be industry versus nature. So we have to make this point that nature is infrastructure, and that our industry cannot survive without it. And that's going to be a challenge. And I think that's where government leadership is really needed.
Another way to view it could be the carrot and the stick. Part of the reason that I've done this podcast is I feel that in some cases, the argument for responsible investment and so forth just hasn't been well made, because if this is actually a better way of investing, it should be borne out if we're accurately accounting for the returns on investment. It should be logical. So in that way, it's more of a carrot as opposed to government coming in with a stick and saying, you've got to fill out these ESG forms or whatever. In a way, I feel like some of what is referred to on the other side of the Atlantic as the ESG backlash and all that is because it's been forced on people without demonstrating that it's actually a better way to invest. And of course, there's charlatans gaming the system and all that, that's for sure, as happens whenever new markets emerge. But in the long run, this should become obvious. And if it is a better way to invest, meaning producing better returns in the long run, should be something that investors demand. It's pull-through marketing. The investors will demand that because it'll be better for their investment, right? And sometimes I feel like we just haven't done a good job on explaining to investors or to the markets. And some of that could be maybe we've got inadequate accounting systems that don't actually fully capture the full cost of things so that the returns are artificially inflated.
That's exactly where we are. The problem is about being forced on people. The problem is by the time investors start saying, oh, this is a good idea, we'll have gone past the point of no return.
You've discussed today how much the functionality and growth of the economy depends on natural capital, but we've also discussed how C-suite executives still seem to struggle to take the responsibility. So what can we do, or what needs to change to engage these executives on the agenda?
I think we have to make the business case more clearly. And there's always this story someone told me about how someone went into the board and started talking about nature risk and all the various taxa of flora and fauna, and everyone was like, okay, this is we're done now. So it's not using that, but actually just talking to about business case. So one of the things we're hoping to do, just for example, and this could be replicated anywhere, is in one region of England, there's it suffers from drought and flood and coastal flood and inland flood, and it's got a huge agricultural landscape as well that's at risk from climate, but also this compound nature degradation and climate. So we are hoping to work with 5 or 6 companies who workforce is reliant on that landscape, so maybe they're headquartered there, or their supply chain in some way, or they're a railroad company that runs through it, or a highways company, and figure out what is your climate and nature risk from this landscape, and what's the cost of capital as a result of that, and can we take that cost to you once proven and transfer it into paying for nature-based solutions on land. And there's a lot of land managers and farmers who are happy to deliver that in that landscape. And I think if we don't start going down to that granular level where you work with businesses to start proving that your climate and nature risk is a business case issue and that there are solutions for you because you can invest in XYZ and nature-based solutions, I don't think we're going to get anywhere, because we're just going to keep batted off that nature's not a business case issue. Some businesses get it. Reckitt's is one I always talk about. I don't know if you know Reckitt's, but they own Durex. So Reckitt's is incredibly worried about its rubber supply chain and what the impacts of climate can be, and also just that sort of undersupply because of over extraction or whatever of rubber. They're really cautious about it, and so of changing their business model to shore up their rubber supply because it's their business case. But how can we sort of make that kind of scenario, which seems so obvious, into a scenario that every company is looking at when it comes to nature specifically?
Who is Reckitt's?
They're a large firm, Reckitt's. They own a whole bunch of brands that you probably know, but one of them is Durex.
I wanted to ask about reporting standards at TNFD. You've mentioned it several times. I'd like you to comment on how effective that could be in generating engagement. But before you explain it, why don't you explain to the listeners what is TNFD? Because in the financial business, we love acronyms.
TNFD is the Task Force on Nature-Related Financial Disclosures. It was developed, actually it was the brainchild of a gentleman called Andrew Mitchell back in probably 2018. And then it got turned into a working group. Actually, my CEO was a co-chair of that working group, and then launched, formally the framework at least, launched last year. And essentially it's built a framework for companies, any company around the world, to be able to assess its impacts and its dependencies on the natural environment, and then produce a report similar to the TCFD. It's worked off the framework of TCFD so that people can, not have to think too much on how they're going to report what those, or disclose rather, the impacts and dependencies. And it follows something called the LEAP approach, which is locate where your businesses are. Amazing that many businesses haven't even done that. Evaluate what your impacts and dependencies are. Assess what's the level of risk. Maybe you have no risk, and then sort of prepare to report on that. But that framework has been developed with global institutions. It's market-led, but it works very, very closely with NGOs and Indigenous peoples as well, because of the importance of those groups when it comes to preservation of nature. So we have this amazing framework, and they're constantly updating it and providing more feedback to help companies really work with it across different sectors. So it's an incredible piece of work. But of course, it's not a standard. And so at the moment, there's discussions around ISSB, which obviously is a standard, is looking at nature. And the hope is obviously that it might, I'm not speaking for GFI, not speaking for TNFD, it might incorporate TNFD within that.
We're seeing that movement in the development and the deployment of complementary financial products. And you've referred to some of these today when we're discussing some of this, like carbon credits and biodiversity credits. Maybe you could explain what these are and what is their scope to actually make an impact from a nature perspective, from what you're working on.
Carbon, I think, is probably fastest route at the moment to getting money out the door for biodiversity, dependent on the integrity of the project. For example, it's not, you're not planting monoculture forests of trees just to sequester carbon, because some trees sequester very quickly, but maybe they're not in the right tree in the right place and they're not right for biodiversity. Those markets are taking off. The challenge with carbon markets at the moment is, one, they've had a lot of negative press from certain media outlets, which is unfortunate and has given an excuse to people to say, well, I'm not going to take part then, which is a real shame, because there are some incredibly good projects that do nature-based carbon. Some projects will sell carbon with like what they call charismatic carbon, or there's a biodiversity uplift embedded in the price, so it can help the price elevate somewhat. There's an amazing project in Scotland I always talk about, and it's called Trees for Life. It's an NGO focused on planting millions of trees across the Highlands because they've been decimated, and rewilding, works with the community, gives a portion of the profits back to the community for more community nature restoration projects. But they sell their carbon sequestration, I don't know, it's more than £75, because they have this wonderful story and there's so much biodiversity in there. And there's lots of projects like that so carbon markets can allow you to get money out the door for biodiversity and community projects if they're run well. But that kind of price is quite rare. Like typically it's about £25, which really doesn't cover the price of, the maintenance on these forests as you plant them, unless only in some developing countries at the moment. So, but carbon, I think, is nature-based carbon is really a way that we can get money out the door quick.
And what about biodiversity credits?
Biodiversity credits, this is what everyone wants to talk about at the moment, and I don't think anyone's settled on what it's going to look like, although we've had guidance from some great organisations on it, the Biodiversity Credit Alliance and the IAPB. So essentially, they want to do the same. People want the same for carbon and biodiversity, but it's nigh on impossible, because carbon is a unit that's in the atmosphere and biodiversity is very much local. So how can you ever have a global biodiversity credit? Like, if I restore a wetland in Scotland, it's very different to a forest in Tanzania. They're not the same. So the challenge at the moment, what is that market going to look like? We have biodiversity units, like through biodiversity net gain and mitigation banking, which is the compliance market, but it's domestic. And I think my personal opinion is that's the way we'll go, that there'll be domestically developed biodiversity credit or certificate type markets, but they'll never be traded in a secondary market. I mean, how can you do that when biodiversity is so localized?
What are some of the limitations of complementary financial instruments that need to be addressed or could be addressed to make it part of the solution?
Obviously, there's the issue of integrity, and actually, are they delivering what they say they're delivering? And some of that you will have to build in to some of these projects the chance for failure. I mean, you might have a wildfire sweep through and you've lost your carbon sequestration, for example, or it might just not work as well as it did.
What do you see over the next 5 years? What are the biggest things that need to change to progress towards a nature positive economy?
I think we need to get businesses on board. I think that's the only way. How do we do that? Do we do it through, to what you were talking about, through a stick, through regulation, or is there some sort of carrot, or as my colleague says, there's a carrot on a stick? Which I love. So maybe there's like some co-design, yeah.
That's your campaign, carrots on a stick.
Or I don't know if it's a stick made of a carrot. I'm not sure where she was going, but she had a really good point.
Wrap and put a bow on things here for me. And in a few words, make the case that natural capital investing represents the next significant frontier in sustainable investing, and that we are on the cusp of something that really is an unmissable opportunity from both the financial return as well as from a sustainability perspective.
I think the way I would frame it up is that we have to be realistic in that the returns at present might not be there for natural capital investing. They are there in pockets, should I say, but not at a mass scale. However, it's going to happen pretty fast, I think, over the next 5 years. One, we do have the Global Biodiversity Framework pushing us forward that 196 signatories have signed up to. And we do have this growing recognition that nature and climate are intertwined. I don't think some of the things we've said that's fully landed, that actually if we're only capturing climate risk, we're not capturing climate risk at all if we're not capturing nature risk as well, because of the compounding impact that we've talked about. And I think that voice is only going to get stronger over the next few years, especially as we see more and more natural disasters where perhaps if we'd had nature-based solutions in place, some of that could have been held back a little bit more. So I think the noise is only going to get louder, but I do think it might take a while for the returns to really come in at the levels that we need. Now, on massive landscape scale and aggregation, yes, you can hit it. I think it's going to take a little bit of a while.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.